Welcome to the ResourceSpots.com podcast.
Hello everyone, this is Steve Strandsman and I'm joined by Carter Smith and Corey Fleck. I just want to do a quick apology here for our long absence. We've been really busy with a bunch of stuff. Most recently, the videos from the San Francisco Hard Asset Conference, which are all now live and available on ResourceSpots.com and also over at the KEReport.com. So enjoy those, check those out. But that's what we've been up to. Now, since then, there are a bunch of new articles that have been put out on ResourceSpots.com. So we're going to run through those and get back to business. Here we go. The top stories are EU and America, not so different after all. Warren Buffett proposes a new tax plan, which is to tax the rich. And we have an article which breaks down the U.S. debt in gold as we break it down to terms that everyone can understand in happy debt giving. Corey, why don't you start us off with the EU and America article?
Thanks, Steve. I really wanted to write this article after the news came out last Friday that the EU talks broke down yet again. It became clear to me that there were some very distinct similarities between the U.S. budget situation and really what the EU is going through. I found two main points from a couple of the videos I watched and articles I read. First point revolves around spending cuts and the needed increases in revenue. David Cameron, the UK Prime Minister, stated, "There hasn't been the progress in cutting back proposals for additional spending, and this isn't a time for tinkering. It isn't a time for moving money from one part of the budget to another. We need an affordable spending cut." I found this quite interesting because it sounds the exact same thing that the U.S. is going through. They keep on trying to nickel and dime, making little cuts here, trying to raise a little bit of revenue here, while they're also cutting this area of the budget. It just seems like these two superpowers, the EU and the US, are going through the same thing with they don't have enough revenue coming in and they can't find big enough cuts or people willing to take big enough cuts in certain sections of the budget moving forward. The second point involves something similar to what, again, we hear in the US, which is the kicking the can further down the road approach. German Chancellor Angela Merkel stated that she believed the members will have to meet again early next year to come to an agreement. This just screamed fiscal cliff to me and debt ceiling on the U.S. side. Essentially, the fiscal cliff is coming up. We're hearing that no decision is going to be made until the very last minute. Even at that point, it is very likely that fiscal cliff is going to get pushed off, or at least the hard-hitting aspects of this will get moved further down the road. Dealing with the debt ceiling, same thing we saw about 4 or 5 months ago, I believe. Actually, no, it was more like 6 or 7 months ago, where the U.S. government had to come together and really deal with the debt ceiling. They waited. The currency got downgraded, the bonds got downgraded, and what did they do? Raise the debt ceiling. It was
a
more
giant
of the
game
same.
of chicken, right?
Yeah, it is, but it seems like that's exactly what the EU is doing. They have 27, it's either 24 or 27 members in the EU. 27. And they just can't come to an agreement because it's too many parties wanting different things. While the US, it's only really two parties that are just both polarized on different ends, fighting for what they think is right, when the truth is neither of them is fully right.
It's similar in the situation that, you said 27 member states, some of which are profitable, others of which are insolvent. And it's the exact same situation in the United States. Some states are running surpluses on their state budget, whereas others are running deficits. Yet everyone kind of has to toe the line. And that's where you're seeing a lot of unrest brewing in some of these states that view themselves as producers, because they don't want to essentially keep carrying these insolvent states on their back. And that's the same situation that's happening right now in Europe with like the weaker members, the pigs, like Greece, Portugal, Italy, Spain. Those guys are not producing, and the producers like Germany are saying, we're tired of dragging you along.
It's the same issue that we're seeing in Canada to a lesser extent. I mean, there's so much of the money and so much of the power is shifted to the West Coast. So Alberta runs all these crazy surpluses. but then they look back east and Ontario's got their hand out looking for more money. So I think that this is one of the problems that comes with being a nation or a conglomeration of nations of such a large scale and scope. Like there's always going to be haves and have-nots, and I don't think that's avoidable in any way when you're trying to deal with this large of a population and this large of a physical area.
Which I agree, it is unavoidable. However, these parties need to come together, or else both of the EU and the US are going to keep on struggling. They're not going to come to a conclusion. They're going to keep on getting downgraded, and one of them is going to fall first, and shortly after, I think the other would fall if they can't come together and come to a conclusion. I agree, there will always be groups that are taking more than they're putting back into the system. However, that needs to be managed by the higher powers. You can't just kick them out. You need to deal with them and get them back on track. Now, I don't know the right way to do that. I don't think there is one right answer of how to do that. However, they need to come together rather than being polarized and thinking just of themselves. They need to think of the entire EU or the US and really move forward with what they're planning on.
Yeah, I don't have the right answer either, but I definitely have the wrong answer, and that is doing what they did in the past and essentially using the debt ceiling as an opportunity to hold the nation hostage in order to prove a political point. And we saw the results of that. It was borderline catastrophic for some parties involved. And, here we are again playing the same game, and it seems like they haven't learned the lessons yet. So it'll be interesting to see how it turns out.
I would say that, especially with the EU, it seems that some of this stuff is systemic issues that were issues kind of within the nations, especially, within the pigs nations, as you were talking about beforehand, as far as, let's say, fudging of some numbers and moving around, accounting kind of tricks in order to make numbers add up and create budgets that, fell in line with, stated, fiscal goals for the year. These were tricks that all of these, member countries, had used in the past and had kind of worked well enough to at least maintain a sort of status quo. And now essentially, I think what we're seeing is essentially facing, like a biting the bullet and saying, hey, like this isn't going to work anymore. You have to actually address your problems, make the cuts that have to come, like provide an affordable budget for your country with a timeline and a goal that shows that you guys will be solvent and able to hold your own in this union. Otherwise, it's not going to work.
I just don't think anyone knows what they need to do, or they don't want to come to the conclusion and actually do that, because essentially the buck is getting passed to the weaker countries in the EU. Mm-hmm. Rightfully so. They are struggling. However, it's not right to make them go through massive cuts when their people are just going to be devastated. Then you're going to have these parties in the EU that stand very little chance of actually climbing back anytime soon.
Yep.
They need to all work together and figure out a plan that's best for everybody.
Have you guys heard about the idea of debt forgiveness as well? Because I think that's something that, while I don't see necessarily playing a role in the near future in the EU, I do think it's an interesting idea, which is essentially wiping out across the board of a certain amount of debt, saying, you know what, we forgive this amount of dollars. Don't be stupid. Let's start again. And I think that that's kind of a pretty reasonable approach, assuming that there are people in power who you trust to not, screw it up and do it again, because it is kind of like a free pass. So it sets a dangerous precedent, but I like the idea of wiping out past problems in order, because it's all avoidable. This is all hypothetical money in a lot of ways. And so if everybody wiped out an equal amount of debt across the board, there would be a starting fresh, which wouldn't hamper a lot of these poorer nation countries that, calling for austerity measures that would essentially render them, useless to the EU for the indefinite future.
I think it's a novel idea, the wipe across the board forgiving of debt. However, I think too much debt is international now, and you can't get groups like Asia or even different North American countries to get on board to wipe out this debt. It would work inside, but I think that it's grown far beyond that and not contained within the confines of just a certain group of individuals.
Yeah, it's a great idea for everyone except for the creditor. So,
Sure.
I mean,
I guess the idea is that in the global economy, everybody is both the creditor and the creditee to a certain extent.
I agree with what you're saying, that everybody is kind of interrelated in this money lending process. However, I just think that a couple of the countries out there, of which we know very little about, and I'm speaking mostly of the Asian countries, because they are so tightly held and so tight-lipped about their monetary policy, I just foresee it being far too difficult to get through to these countries and really make them understand that it's better for everybody if this debt is forgiven. Because I think that there probably is a slight imbalance between the creditors and the debitors, but I think it's too hard to go across international boundaries, because quite frankly, if I was in Asia and saying, you guys owe me this much money and you're telling me to forgive it, what's going to stop you from doing it all over again?
Exactly. And I think that's a completely reasonable argument, and probably the reason that it's not going to happen. But I was just kind of throwing it out there to see, because I do like the idea in theory. It just does also present its own set of problems. Now, speaking of things that present their own set of problems, Warren Buffett called for a minimum tax on the wealthy this week in the New York Times. And his point was that he called for it regardless of how they made their money. So the heart of the argument is summed up in this paragraph, and I quote, "We need Congress right now to enact a minimum tax on high incomes. I would suggest 30% of taxable income between $1 million and $10 million and 35% on amounts above that. A plain and simple rule like that will block the efforts of lobbyists, lawyers, and contribution-hungry legislators to keep the ultra-rich paying rates well below those incurred by people with income just a tiny fraction of ours. Only a minimum tax on very high incomes will prevent the stated tax rate from being eviscerated by these warriors for the wealthy." Now, throughout this article, Warren Buffett goes on to elaborate on his ideas about this simplified tax code that will tax the wealthy in order to kind of help resolve some of the fiscal imbalance that is going on, and address the issue that Romney faced in his campaign in terms of his stated, releasing his taxes and showing, his tax rate compared to that of the average person, which became a huge talking point and controversial issue throughout the campaign. Now, the important thing about this argument to me was that, in Buffett's opinion, the investment stifling argument, which is the argument that people make that the people who are these ultra rich are job creators. Therefore, if we're taxing them at a higher rate than everybody else, they will be less inclined to spend their money in the United States, therefore reducing jobs or reducing investment in the United States because they'd be forced to pay a higher tax rate. Buffett feels that is flawed because he worked under far more burdensome taxation conditions in the 50s and 60s and never had an investor pass up on a business opportunity because they were worried about the taxes being too high. Now, I'm not sure what you guys think about this, but Corey, how would you see these taxes affecting you as an investor?
Oh, well, personally, I guess there are two ways to look at it. First of all, Buffett was saying that we need to raise the minimum threshold of what is considered wealthy or what a yearly income is considered rich, which I agree with. He said it needs to be raised up to $500,000, up from the $250,000, which makes sense because living in a big city, really $250,000 for a household income is doing well, but you're in no way the upper echelon of people. So I agree with that point. And quite simply, I don't know when these tax policies came into effect, but taxing capital gains on a lower threshold, so essentially 50% of capital gains in Canada, that's how those are taxed. In the US, I believe it's around 15%, sometimes even 12%, can even be brought down lower than that, is all just, it seems really contradictory to me that these are the job creators, because these are not the people that are in the companies. These are the people that are simply investing in the companies. And yes, you need money to get companies up and going, but when you're making money off of the stock market, you're not creating jobs in any sense. You're not even keeping a company afloat because that money is not going to the company unless you put it in some sort of offering, which quite frankly, capital gains a lot of the time are made simply playing the stock market, which is a glorified gambling system out there that you can make money by betting on the right management or the right product idea. And okay, yes, you are taking more risk. However, you're making money, and this is income. This is money coming into your pocket. So I don't necessarily have a problem with putting a flat tax or really raising the tax on these capital gains, because the rich are the ones that have the excess income to invest. Therefore, they can make more on capital gains. Yes, they can also lose more, but they can make more on these capital gains. And you get a tax break for capital losses that can only be applied against capital gains. But capital gains are taxed at such a low rate in the U.S. that you have the Romney situation where he's making tens of millions of dollars and paying less tax than his assistant. Yeah. So I do find that very strange, and I don't have a problem with what most of Buffett was saying in this article. Obviously, there's a lot more that would need to be laid out, but I do like the idea of raising the tax on the rich. However, I just don't see that happening anytime soon, because his one sentence of blocks the efforts of the lobbyists, lawyers, and contribution-hungry legislators. They're a powerful, powerful group out there that is tough to bring something like this through.
Absolutely.
Yeah, I agree with what you said there. To me, the interesting sentence in there, and you just talked about it a little bit there, was regardless of how they make their money. That to me was a pretty big blanket to kind of toss out there, and almost sounded like a flat tax at the top end rather than what we have now, which is a progressive system, right? I mean, as you were saying about capital gains, I mean, really, I mean, if you play it the right way, it's an effortless source of income, right? I mean, you're not doing any work, as you said. Your money's out there working for you. So the fact that that would be thrown into the same category as someone that is actually running a business, has employees, is out there producing, it, to me, creates a problem on a philosophical level, just because those are two very different sources and styles of generating income, and one brings with it a lot more kind of real-world responsibilities.
Right now, though, the investment income that does all the work for you is taxed at a lower rate than the money that you're out there, grinding away and making.
Right.
So are you almost proposing an inversion of the tax code right now?
That, to me, makes more sense. Just because, it's all about threshold, too. Buffett talks about how he didn't, he had more kind of tax restrictions when he got into business at in the 50s and 60s. But that was a very different time. And you look at the threshold now that it takes, not even to necessarily like break into certain industries, but even to just get started on like a small business or something. And we're talking about a significant amount of money. And so if these are the hard workers out there that, are doing what they know how to do, whatever that occupation may be, and they're basically being slapped down at the beginning, that's a problem.
I see the blanket tax code element of Warren Buffett's plan actually intriguing, because I think that once you reach a certain threshold, it doesn't matter how you've made your money. I think that you should be taxed at a certain amount, because it's so far above and beyond that what the regular person is capable of making. It becomes less about social mobility, because like your status and the amount of money that you've made won't necessarily be impacted to the same way that the same percentage of tax would affect somebody who makes substantially less money than you.
Yeah, and I mean, again, going back to thresholds, I think when you reach a certain level of wealth where the interest that you're earning on your savings is enough for someone to live on in a regular lifestyle, then you've got enough money. In which case, you can start to talk about higher tax rates and that sort of thing. But again, I mean, it comes down to kind of, what is fair and what is not, and who's to say like where the division is between those things. And for me, I don't think that just kind of a blanket kind of taxable amount thrown on kind of arbitrarily is necessarily the answer. I mean, we arrived at this kind of progressive tax code for a reason. And I think it just takes some careful looking at and reevaluation to tweak the tax code so that it's fair for everyone.
And see, I agree that the progressive tax code is useful, and that is why it has been around. However, now with all the tax loops and all the different categories of income, the rich have found a way and have essentially lobbied a way to pay less tax. And I don't necessarily think that's fair. It is tough to put a ceiling or a level on what is rich.
Well, it's hard, right? Because it's like, how do you tax somebody for being successful?
Exactly.
And where do you draw that line?
Well, and no, I think everybody should be taxed. And if you don't make as much money as somebody else, then yes, you should be paying lower tax. However, when you get up to a certain level, and I'm not saying that the $10 million level that Warren Buffett claimed, there should be a certain aspect where, you know what, you shouldn't be able to get all these tax breaks. I don't necessarily agree with that. When they're paying such a low percentage of their income and they're making so much money, yes, they're still paying a lot in tax, but they should be contributing more, because unfortunately there are people out there that are not contributing, and it's America. So you need to support those people because they're Americans.
And you know what? I agree with you. The one thing I'll say is that what Buffett is proposing here seems to me to be a hasty kind of like one size fits all solution. And
Only
sometimes
to the
that's
rich.
Yeah, well, sometimes that's what you need. But I think if you slapped something like this down and forced it through Congress, that it would have unintended consequences that would reverberate through. I mean, this is a complicated issue. And I don't think it's as simple as saying, well, we'll just take this bracket right here and bump up and everything will be good.
No, I agree. But I also think that there's only so much hand wringing and sitting on your hands that you can do. And at a certain point, you got to pull the trigger and say, you know what? Here's a quick fix. It doesn't solve all of our problems by any means. Quite frankly, it only scratches the surface, but it is a step in the right direction. And we can make amendments to it as it goes. And it'll really help solve some of the debt crisis that the U.S. economy is feeling right now, which takes us right into our third article of happy debt giving. Carter, why don't you lead us through this, bud?
Thanks, Steve. Well, I read an interesting article this morning just talking about how the U.S. national debt had gone up by $24 billion on Black Friday.
Oh, just a little $24 billion?
Just the little old $24 billion bump. And that made me start to kind of think about the status of the national debt. You know, we were in New York in May, walked by the national debt clock there on the street. And, it's something that's always there. It's always kind of looming in the background. Everybody talks about it all the time. But to me, it's such a large number, at $16.3 trillion now, that it's almost inequitable, in my mind, from a perspective standpoint. And that was what I wanted to kind of look at through this article. And so, it was just kind of a fun little thing that I did. I went through and I looked at the debt and I tried to quantify it in terms of gold. And at today's price of $1,700 and $1,742 per ounce of gold, the U.S. national debt at $16.3 trillion is equal to 9.34 billion ounces of gold. Now, again, this didn't really make the number any more, contextual to me because, at most, one time I held a several ounce bar of gold in my hand, so 9.34 billion ounces of gold again was a bit inequitable. So I took that number and I tried to break it down again. In terms of Fort Knox, which is the largest gold reserve in the United States. And according to the latest information that I found, in Fort Knox, they have 147.3 million ounces of gold. So if you took the same number, 16.3 trillion in U.S. national debt, and you divided it by the gold ounce, which is 9.34 billion ounces, and you took that and divided that by the amount of ounces in Fort Knox, the U.S. national debt is equal to the equivalent of 63.4 Fort Knoxes. So, if we were to try and pay off the debt or whatever, in a hypothetical situation, we would need 63.4 Fort Knoxes in order to pay it off in terms of gold. Now, again, I've never been to Fort Knox, Kentucky. I saw it on James Bond once in Goldfinger, but this is again kind of an inequitable number. So I took it and I decided to break the number down per person. So according to the latest U.S. population census, we have around 314 million people. So you take again the national debt, 16.3 trillion divided by 314 million, and that equals roughly $51,910 per person in U.S. debt. So you take that and divide that by the ounce of gold, $1,742, and it means that if the debt were called, we owe 29.8 ounces of gold per person.
Carter really hadn't been doing enough math in his life, so he really wanted to get some more division going here.
And for you silver bugs out there, just for fun, I took that same amount and found out how much that was in silver, and that is 1,526.78 ounces of silver in debt that you owe, or roughly 95 pounds of silver.
The crazy thing about all those numbers to me is that even at the most broken down base level, easiest to understand numbers, it's still just such a preposterous amount of money or gold or silver that it doesn't even it still barely computes.
It's actually one thing that I found quite interesting, because if you look at the debt, yes, it's been growing exponentially. You also look at how gold has been moving. It's been growing exponentially as well. So this actually goes further into the point of how gold is more closely tied to this growing debt than anyone really realizes. Because the fact of the matter is, the greater the debt of the U.S., the greater the value of gold, because it has moved in that same proportional move.
That's interesting.
Throughout.
I wonder if you could chart the price of gold kind of along the U.S. debt timeline and see how much in gold per person the U.S. debt would be, and if it would stay in a similar ratio.
It's actually quite interesting. On one chart is the U.S. debt limit compared to the gold price has been pretty much correlated since the mid 1990s. Moving forward, that every time gold spikes, the debt limit seems to also spike. And one chart that I'm looking at that we'll post on the site later is a U.S. national debt in tons of gold. And actually, the tons of gold spiked in the early 2000s and has dropped a little bit going forward. So this then proves that the U.S. debt is growing faster than the price of gold. However, maybe it makes us question if gold should even be worth more, which is why people, I think we here, are calling $2,500 for gold, because it has actually started to fall behind the total debt of the U.S.
I think this was kind of just a fun thing that I did, but it does raise some interesting questions, and it would be interesting to revisit this subject in a year or something, to see exactly where we've gone, and even to go back and do it for a couple more years. But the bottom line is, we sort of entered the hockey stick part of the chart as far as the U.S. debt goes, because each year, it's as you said earlier, exponential growth, and much like the EU and the situation that you were talking about, it seems that we're approaching some sort of conclusion, to this issue, because it is to use a buzzword here, it is unsustainable growth of the debt.
Which ties in perfectly with our Pulse poll, which is now closed, as we asked respondents to weigh in on where they thought the gold price would be at the end of Obama's second term. And 93% of respondents believe that the gold price would be either higher or much higher after Obama's second term, with a mere 7% voting that the gold price would be lower. Now, do either of you guys disagree with that?
No, I think what we're talking about here, the charts and everything, definitely point to that being a very high chance of being reality.
All right. So now with the new Pulse poll question, weigh in here. What will get resolved first? The U.S. fiscal cliff or the European debt crisis? So vote in now, vote early, vote often, and get your answers in before next week's show.
All right, that's it for Carter and I, but stay tuned as Corey's going to be chatting with Rob Gray, VP of Exeter Resource Corporation.
Welcome back, everybody, to the second segment on the ResourceSpots.com podcast. I today am joined by a good friend of mine, the VP of VP of Communications for Exeter Resource, Rob Gray. Rob, thanks for joining me.
Yeah, happy to do that, Corey. I hope everybody's doing well, and hi to your viewers and listeners.
Yeah, well, Robbie, touching on hopefully everyone's doing well. We've seen the market continue to slide in the last little while. Lots of different aspects are being attributed to this. However, I wanted to touch on the fiscal cliff, which is coming up at the end of December. Do you think this is having a fairly big impact on the depressed market that we're seeing?
I think people are worried, and I think it is big. I said that a few weeks ago that this was going to happen. I said it's going to get worse before it gets better. People I talk to, and a lot of investors, are scared. They have cash, or they're getting out of the market, or they're putting a toe in because some of the stocks they've loved for the last year have got really, really cheap. They put a toe in because you never know where the bottom is, and then they say, I'll put a bit of a toe in maybe December 30th. I mean, the 31st, I don't know. Obviously, you're now seeing special dividends by major corporations come out surprisingly before the end of December. Wonder how that is. They know what the taxes are going to be. I hope they can figure this out. In the whole scheme of things, the fiscal cliff is important. It's going to affect a lot of people. But obviously, there's other things that could be going on in the world, like Greece, Europe, and even the U.S. debt. I hope we can look at that down the line. So I think it's a little bit of this. This is a bit of a blur. It's on the radar screens of a lot of people, and it is serious. So we have to be mindful of that going forward.
Well, I like your point about the euro concerns as well, because just last Friday, the EU pushed the can further down the road. They couldn't come up with the budget decision, and they decided that they're just going to take a break and meet again in the new year. So it's really that process of kicking the can further down the road. Same thing that we saw with the debt crisis that came, raising the debt ceiling about 8 months ago with the U.S. Right. Seems that we're consistently seeing these two countries kick the can further and further down the road, and gold and silver are doing well. However, you just don't think people are putting their money into the junior stocks, or what are they looking for out there?
No, I don't think they're putting their money in the junior stocks. The real guys gals that buy in these markets are buying things that have cash, have a resource, and have good management. They don't need a drill hole right now. We're not in that type of market. So if a company has cash, good management, and a resource or a good project, they'd rather pick it up here because it will move faster when it is. No one knows when the bottom is. Also, you can also buy these senior companies. Look at Barrick. It has its own issues. One of my favorite companies I like to look at is Yamana Gold. It's doing quite well, no debt. But, you would think in this environment they'd be doing better. But people are afraid. I don't know how many trillions of dollars are on the sideline, but it's a lot. Someone told me the other day. So I think that's also it. And people are scared. I think 08's early 09's in people's minds, and they'd rather be in cash and get nothing than lose everything. And I think that's what some people are thinking.
Well, completely, yeah. That whole 08, 09 thing. We saw a quick rebound after that, but right now we're hitting those same lows, touching at the same levels.
Yeah, we are. And I talked, and you've heard some of the people that we've gone to different conferences with, Corey, is that they are looking at this and saying, is it as bad as 08, 09? It feels pretty bad. It might even feel worse for a lot of people. It came so quickly and hit so hard, and then there was a good reaction. They put something together, and we can disagree or agree if it was good, bad, or indifferent, but something was there. And I think politicians need to just say, let's just do the right thing, whatever that might be. And politicians don't do that. They need to get elected. And the sad thing is, you and I will have to pay for it, and my children and your children to come are going to have to pay for it. We need to take some opportunities here and say, okay, let's go ahead and do what's right. There'll be pain. There will be pain. But in the end, it will be better for all of us going forward.
Oh, I can completely agree, Rob. We're stuck in this situation where we keep on electing people and they just can't get along, can't come up with a decision. And we're struggling in the markets, everybody, all around. So,
yeah, everybody, including the senior companies of, even big companies. So they need to figure this out. And I just don't know, being that they're politicians, this might, and I'm sorry to say this to all your people out there, Corey, this might not end until December 31st at 11:59 p.m. as it's going. It is a very strong possibility. I mean, when you see CNN and CNBC saying there's 35 days, and I look up at my TV and there's a time clock of 35 days, how many seconds, that doesn't help either, because that is the media. It worries people. It worries people that are going, hang on a second, is it safe to invest? We're talking about higher taxes. Is that the end of the game? No, people pay higher taxes all around the world. But, there's other things associated with it, and people hate uncertainty. And right now, today, we have uncertainty. Hopefully tomorrow we'll clear it up.
Very interesting, Rob. Thanks for your insight. I really hope we're not stuck at the last minute there on the December 31st. However, it's looking that we're going to be, and even possibly they might kick it further down the road. It has been their style recently. So, Rob, thanks for joining us. I will chat with you soon, and we appreciate it.
Thanks a lot.
All right, there you have it. Another week and another episode of the ResourceSpots.com podcast. I really hope you enjoyed this week's show. Rob Gray's a great guest. We've had a lot of interesting topics, and we have a lot of great content on ResourceSpots.com and KEReport.com. As I mentioned earlier, we have all kinds of videos from the San Francisco Hard Asset Conference. We've got original articles. Al Corlin over at the KE Report is always posting lots of stuff on a daily basis. So make sure you're checking in often, checking in early, and we'll be back with you next week. Thanks again.
For exclusive video, radio, and written content on commodities investing, visit ResourceSpots.com. ResourceSpots.com. Superior Commodities Investment Insight.